For the quiz, I gave you a fairly simple question about the steps which business goes through to issue securities, right? Is it on recording? No? Is it pretty good? Okay. So, pretty much we had only very few students who actually did the steps. So, today's chapter is on investment banking, and we'll try to do some of the, again, repeat the basics of issuing a security. Well, first step is, and I again discussed this during the bonds and repeated during the stocks, is choose or select investment bank. So the first step is, if you're a company, you gotta somehow choose, select an investment bank. That's pretty much clear. As part of the choice, one of the key is negotiate with an investment bank. So you can negotiate, what is it? Best efforts. Or firm commitment. All right, so the investment bank will later on, not at the first step, but later on, maybe I'll write it actually later. They'll determine the price, then they'll do research or cover the stock, and so on. So once you've done the investment bank, the second step might happen, might not happen, will be Underwriting Syndicate. A syndicate, again, is a group of institutions with a common goal. Underwriting Syndicate will be a group of investment banks and possibly brokers who will effectively underwrite the issue of the stock or the issue of the bond, in general the issue of the security. So this will be here. When you choose the investment bank will become lead underwriter. So the one bank will be number one, and that bank will make a syndicate, maybe 3, maybe 10, maybe 30. The syndicate, whether you have or don't have a syndicate, depends on the size of the deal. If it's a $20 million deal, one bank will do easily. But if it's a $1 billion deal, obviously just one bank can't handle a $1 billion deal. Again, when you do the syndicate, one of the key benefits is that you spread the risk. If you're a single investment bank, you take the whole risk. Otherwise, when you have 20 investment banks, you divide the risk between 20 banks. So one benefit is spread. In this case, it's called underwriting risk. And the other one, the syndicate will provide extra marketing. So it's one thing, one company to advertise, it's a completely different thing. You have 20 investment banks and brokerages to advertise. So increased or improved marketing. Now, what people don't understand, especially guys like you who are young students who want to get an investment banking job, is that being an investment banker, you're like a salesman. Your job is to sell securities. So you're no different than a car salesman trying to sell a car. Well, hopefully, if you become an investment banker, you're just going to be a salesman, but getting paid 10 times more or 100 times more than a car salesman. So that's the second step, number 2. Let's see what else we got here. So the syndicate sometimes will be called or known as a selling group. Selling group. It is possible, as I explained, that the sale will be unsyndicated. Unsyndicated is going to be only one lead underwriter, and nobody else. So it's going to be unsyndicated. In this case, the underwriter will be acting alone. Alright, step number three is pretty much anywhere in the world. Now here, there will be a lot of differences around the world, but it's very simple. It is registration. Somewhere, somehow, there has to be a registration. In the United States, it will be the SEC, but in general, the registration is with the regulator. Whoever the regulator is in Japan, China, or Russia, you somehow, somewhere, there is a process to register. And there will be a registration statement. Again, I've explained a lot of this. And the statement's got to be the full thing of pretty much everything related to the security and the company, okay? So I've got to describe the company, address, and everything else. And the second piece will be a prospectus. And the registration statement will be the full detailed information. The prospectus is just a summary. It's just a short, sweet marketing version. So the registration statement could be 50 pages, 100 pages, okay? Depending on the company and background, could be 200 pages, right? Very few people can actually read it because it's mostly legal language. The prospectus will be a marketing. It's going to be like 2, 3, 5 pages made for including doctors and lawyers. It's going to be for other investment bankers to make the sale. So this is the detailed one. This is the summary one. And then, well, we can add it here. We can add it as a next step. It doesn't matter. Is what's known as the red herring prospectus. Red herring. This is a separate prospectus which the investment bank will build, will develop, which the investment bank will provide to potential customers who can see it will not have the price, and it will be clearly understood that the red herring prospectus is the same as preliminary. It's not final. And that the red herring prospectus, everybody understands, is not approved, not final. But they understand that it's probably very close to final. And then at one point will come later on will come the approval. When the registration is approved, then the red herring prospectus will become almost final. It will become final on the day when the security is issued with the price. So when it's approved, everything is final except the price. And the price will, depend a lot on the day on which it is issued. It will depend a lot on, was the day a good day trading, a bad day trading, is the market feeling good or feeling bad. So the last thing to be determined is the price, okay? And the red herring prospectus is preliminary. When the registration is approved, it becomes almost final. Okay. Next one is, I've already covered it again before. It's the marketing and advertising. The marketing and advertising part has special investment banking term. One is called the roadshow. Road. The roadshow is basically the investment bank will be going from town to town, from city to city, from mutual fund to mutual fund, from pension fund. It will go into potential customers around Wall Street in major, which could probably also be Boston, where mutual funds, hedge funds, and it will be presenting the red herring prospectus and will be trying to convince potential customers to invest. So roadshow is basically going and showing different customers, and this process is known, it's the same thing as book building. Book building is you build a book. You develop a nice book with all potential customers who will express their interest. For example, a mutual fund will say, oh, I want from this stock, let's say if the price is about $20, I want about 1 million shares with a price of about, let's say, $20, okay? So I want about $20 million of this stock. Someone else will say, I just want $2 million. A third will say, I want $50 million. So the book building will basically give you the book of who are the potential customers, what their interest is, how much they want to potentially get, because some of them will say, well, if it's $15, I want 1 million shares, but if it's $20, I want only 100,000 shares. In other words, some customers will be very price sensitive. They'll want to buy only if the price is good. So they may indicate a price range, and for that price range, they'll indicate how much shares they want. So that's the book building process, or sorry, step in the process. And let's see what else we got. Part of the book building will be what's called a subscription. Subscription is an expressed desire by a customer to buy a certain amount of shares, possibly at a certain price or at a certain price range. So that's a subscription. And the last is first day of trading, or first trading day. Well, here, during the marketing and advertising, the price will be determined after the market closes at 4 o'clock. So maybe they'll determine the price anywhere between 5 o'clock in the afternoon and maybe 10 o'clock in the evening. So sometime around 6, 7, 8 o'clock, they'll determine the price. They will contact all subscribers. They'll send a message to everyone on the book. Hey, this is what it is. They all know everything about the prospectus. This is what the price is. Tell us how many you want. And then they will see, if they're able to sell all the shares. If they are able to sell more than what they have, we say that it's oversubscribed, okay? Or if they don't have enough people, it's going to be undersubscribed, okay? And then they'll distribute the shares overnight. They'll distribute them around midnight. And then the next day is the first day of trading. And the stock may trade way above its initial price. It may trade below the initial price. In general, it is believed, of course that's totally incorrect, but it's a belief, that if it trades well above, the IPO is successful. Well, the answer is it was successful only to those who got in on the initial IPO the previous night. So if the price was determined to be $20, but in the next morning it trades at 23 or 25, well, you made an instant profit of whatever $5 on 20 is, like 20%, okay, or 25%. At the same time, if it trades below the price, it's considered failure, okay, which of course is not quite correct, and there's a big discussion, but it's in corporate finance. The correct way to think about it is this. If the IPO was priced at 20, and at the end of the first day is at 25, this means that you could have potentially priced the IPO at 25 and sell it all. It simply means that the investors who got into the company made a return, made a profit. But the company itself collected less money. The company became poorer. So if the company, let's say, had 2 million shares at $20, the company raised $40 million. And the company will have $40 million at the end of the first day. But if they sold the same 2 million shares at 25, the company will have 50 million in the bank. So the company's prospects at 25 and a 50 million cash in the bank are much, much, much better than the same company with 40 million cash in the bank. So yeah, the investors may have gained on the first day of trading, but their gain on the first day of trading, they've gained a company which is a lot poorer, $10 million poorer, which is the same way of saying is the investors gained on the first day 20%, but the company lost on the first day 20%. So it wasn't really a genuine gain. It becomes a genuine gain if at the end of the first day you sell your shares and you pocket in 20% profit. Alright, so these are the basic steps of issuing a security. And I'm moving back to my main topic of today. Again, what I've decided to do is kind of like the following. I'll be covering for the rest of the semester financial institutions. Financial institutions are divided into two primary groups, depository and non-depository. I'll begin with the most important and most popular non-depository institutions, and I'll leave for last commercial banking. There are two reasons to leave the banking, and if you don't have time, we won't cover commercial banking. Number one is you've already had money and banking course, so you should have an idea about commercial banking. And number two, those who will study finance, next year, fourth year, you'll have a commercial banking management. You'll have a complete course focused 100% on commercial banking. So this course is not focused on commercial banking, it's focused on everything else than commercial banking. So today we begin with investment banking. Investment banking is almost always taught together with securities firms. So usually goes together as investment banking and securities firm. So what is a securities firm? Well, you gotta keep the camera a little bit on this side. Yeah. You can move the handle. Okay. All right, so securities firm is a financial institution which assists in trading securities. They assist in trading securities on the secondary markets. The most common one will be brokerage, which will connect customers, investors to the market. In other words, a brokerage will assist investors. They could be mutual funds, they could be commercial banks. Most commonly, they'll be just ordinary people to buy and sell securities. So these will be brokerages. And the second part of what securities firms will do will be market making. Again, all of this is related to secondary markets, okay? And the other one will be investment banks, and they will be specializing on the primary markets. In general, the narrow definition of bank is financial institution associated with issuing securities, but you may have a little broader definition of financial institution that specializes in corporate finance. And corporate finance is associated with all financial needs of major, big-size corporations. Corporations that are what we call the biggest corporations in the world. In other words, investment bankers won't deal with tiny little companies. They're too big to deal with little people and little businesses. They deal with big business, okay? So corporate finance serves the financial interests of big businesses. All right. They do structure and other stuff. Let's see what else we got. All right, so a little bit of basic history. At first, investment banks were partnerships. A few guys with a little bit of money will form a partnership. Investment banks will be very small. There'll be only 5 or 10 or 20 guys working on a company and trying to sell one security at a time. In whatever the 70s or 80s, investment banks were converted to stock companies. They became public companies. So these partnerships were private. And the most important characteristics of these private partnerships is that the owners who own and run the company risk their own capital, risk their own money. So these private partnerships will be very risk averse. Risk averse, meaning they're unwilling to take any risk. And as a result of risk aversion, they'll be doing low risk. They'll take very few risks. Every time they'll pass the risk either to the business customer or to the other side, to the investor. They won't be taking any risk. All they're doing is a deal where they get the securities and then they sell them for a small margin, for a small profit. So later on they convert to public companies. This will mean that they'll issue stock themselves. Their own stock will be traded. They'll get professional managers, and now the professional managers will be playing with other people's money. They'll be playing with investors' money. Now, the investment bank, the managers don't risk their own money as much. They'll be doing a lot of risky investments. They'll get into gambling. They'll convert the stock market into a giant casino where everything is a gamble and they gamble on anything and everything which is a financial instrument. So suddenly things change to high risk. So they're doing highly risky stuff. Let's see what else we got here so that now over here they'll be also doing some market making, and market making will be also considered relatively low risk business. All right, let's see what we have here. Types. Investment banks could be what's called full line businesses, full line firms, full line banks. Now it's important to understand, I've repeated this many times in this course, an investment bank is not a bank. They call themselves a bank to make themselves look respectable, okay? To make the appearance of what they're not, okay? So, but they are not a bank. They don't accept deposits. Usually they don't make loans. They don't do standard, what we now call commercial banking activities. But commercial banking is considered more respectable, okay? So they, instead of, back in the old days, they called them securities firms. They changed the name to an investment bank. An investment bank is appealing and attractive, and most people don't know what it is, don't understand what it is. But if you say, oh, I'm a banker, sounds very nice, okay? So investment bankers, the first important thing is they are salesman. The job is to sell securities, okay? So, if you're a salesman, one of the most important things, at least for salesmen in America, is appearances, okay? You gotta appear nice and attractive and smooth and all the other things. So, they call themselves bankers and they call their firms banks. A full-line bank will mean, full-line mean that it will offer all the complete range of securities business. They'll offer all the stuff related to corporate finance and all the stuff related to secondary markets. So they will be offering everything related to primary markets, which is mainly issuing securities, to secondary markets, which is brokerages and market making, and everything else related to corporate finance. So these will be the full-line banks or the full-line firms. They will be doing both what we call corporate finance and what is also called as retail finance. Retail finance refers to servicing the needs of small investors, usually individuals, usually families. And retail finance is almost always associated mainly with brokerages and brokerage services. So, you're just a guy, you want to buy 50 shares of a particular stock, they'll help you do that. Or, you're a major corporation, you need 50 million to raise capital, whether it's issuing stock, issuing bond, or they may also negotiate for you, say, hey, I need a $50 million loan, and they'll contact banks or other investors. They will somehow help you facilitate, get the loan. So full-line banks will be doing both big business and also possibly small business and individuals. Let me see. So, you will have only full-line banks. The second type, well, it's going to be here, is going to be financial institutions, investment banks, which specialize strictly in corporate finance. In other words, they will not be doing the retail finance. That's number two. So, you got the full-line bank, that's the one type. They'll do everything for everybody. Sometimes they're also called national full-line bank. In other words, they're going to be serving the whole country, okay? Then there are going to be those who specialize in corporate finance. Let's see what else we got. Next will be discount brokers. Discount brokers will offer brokerage services at a discount. All they do is, I think I covered this last time, is execution. Execution. Let's do this. All right, we'll go here now. Gotta move the camera. So, brokers dealing with customers now will be separated into two. One of them will be full line brokers. They will be providing not only the purchase and sale, they'll also provide investment research, and they'll be also provide investment recommendation. So they will provide research, recommendation. The research costs money. They may have dozens or hundreds of researchers in there, called the staff researchers. They'll also be buying from other investment banks research. So in general, there will be, they will provide a lot of information. And the other types of brokers will be discount brokers. Here, investment recommendation, and there will be also investor advice. They'll tell you, look, you got too many oil stocks. We think that that's too much exposure, too much risk to one particular industry. The full line brokers say, well, maybe we think you should invest a little bit more money in technology. Maybe we think you should put your, let's say, 10% of your money into biotech. So first, they'll tell you, well, we think the biotech sector is good. And then, of course, they'll give you a specific recommendation. We recommend you buy this biotech stock or that biotech stock. And when they come back and say, well, I want to buy, I heard about this stock, they'll come back and say, well, our research suggests that the stock growth is not as good as people think, and we don't recommend doing that. We don't recommend buying the stock. So, brokers, full line, you can actually, one of the key ideas with a full line brokers is that you're going to have your own broker. Your own broker, you can actually call the broker and talk to the broker. So you can maybe spend 10, 20, 30 minutes with your broker, and he'll tell you about their research, their recommendation, and the broker will give you advice, and based on the conversation, you, with his help, are going to make an investment decision, and then the broker will execute the decision for you, which will mean sell these particular stocks and buy those particular stocks, or securities, could be bonds. Now, brokers will also offer you to buy mutual funds, usually their own mutual fund run by their own investment bank. Broker will be usually a branch or subsidiary of the investment bank. Well, the discount broker is you make your own decisions, and the idea of discount brokers is that they are cheap. They provide cheap execution, maybe $7 to buy and sell some securities. You want 50 shares of something, you're going to pay $7. Here, these are relatively expensive. Here, for a trade, you may pay anywhere between $15 and $50 per trade. Some of the top brokers could easily be charging you $100 per trade, of which they don't charge $100 for the trade itself. They charge for the research, for the recommendations, for the advice, or all the other supplementary services which they provide on top of trade execution. So discount brokers do only trade execution. And trade execution basically means they'll buy and sell securities for you. That's it. All right, let's see what else we got. You may have, so these full line, they'll be national. Next one will be regional. Regional. Securities firms. So there will be regional securities firms, they'll specialize. They'll be probably divided in, focus on large customers or middle customers or small customers. And they'll focus in a particular region. Maybe the Chicago region, maybe New York, maybe the Boston, maybe California, maybe only San Francisco, whatever the area is. And finally, it could be part of the discount brokers, it could be, but it could be a completely separate one. It is called electronic trading. Electronic trading, let's see, they call them, they just call them securities firms. All right, now, question is, what's the difference between electronic trading securities firms and discount broker? Discount broker is attempting to service a genuine investor. So you have, let's say, $20,000 and they'll try to get you some securities. In a discount broker, you will buy and you will sell securities, but it's not trading. It is investing. You will buy, you'll hold the security maybe a couple of months, maybe a couple of years. If you make a nice profit, maybe you can sell early. If you have a loss, maybe you can sell and take your loss early. But overall, the idea of a discount broker is going to serve a genuine investor. Here in electronic securities firms, they will offer trading. Which means that the customer will be buying and selling possibly dozens of times, 10, 20, 30 times in a single day. The guy may actually buy and sell hundreds of times in a single day. So here we talk mostly about day trading. So they'll offer day trading services where a guy could be holding a position literally for a couple of minutes or only for a couple of seconds. So maybe they'll sell a security 5 or 10 times in an hour. Maybe 100 or a few hundred times in a whole day. So this is mostly trading. And the second big piece or part of that trading will be basically speculation. So will be a guy, for example, there'll be an IPO. The IPO will start trading at 9:30 in the morning. The guy thinks, this IPO is going to go up from $20 to $25. The IPO opens at $22. He says, it's already up $10 at the open. He thinks it's going to close to $25. So he'll buy a bunch of shares, hoping he's going to make a big profit. Okay, so he's going to speculate, which is different from trading where he can buy and sell maybe 5, 10, 20 times or 100 times today. Okay, and of course they can do trading with stocks, they could do trading with bonds, they could do trading with securities, currencies, and you can also do trading with futures or options, whatever. The idea of the trading system is that they mostly provide buying and selling for a very low price, okay? And a lot of times they'll actually provide, sometimes, but not always, location. Location is there's going to be an office. The office will have only fiber optic cables. It's going to be extremely fast internet. It's going to be connected straight to the broker. The broker is going to be connected straight to the exchange. You actually go in the office during trading hours and you have a computer. Something happens, your computer dies. You can go and immediately shift and sit to someone else's computer. There will be a risk manager in the office who will be watching, maybe 20 traders. If something goes wrong, the risk manager may immediately close your positions. In other words, you may have possibly some minor supervision. So in that particular case, it will be what will be called a trading firm with trading office. Okay, so the location means they'll offer a trading office. All right, let's see when we get a break. Example here will be E-Trade. At least in the US, people know E-Trade. All right, and the next one, which at least in the US and California and San Francisco, is a venture capital firm. Venture capital. But it's a venture capital firm. So, what is a venture capital? It is a pool of investors' money. So, investors will pool their money together, meaning they're going to put their money together. Okay. And the key is that they will be investing in new businesses. This will include especially new technologies. So they'll be new. The second key characteristic will be unproven. Like cure cancer. Well, chances of finding a cure for cancer are extremely low. But again, because chances are very low, because tens of thousands of people have tried to do it and have failed, if you're able to do it, you're going to be making hundreds of billions of dollars. Okay, so it's going to be phenomenally profitable if you succeed. But if you don't succeed, most likely you're going to fail. So this will be, because it's unproven and new, it's going to be highly risky. Venture capitalists will finance weird stuff like Facebook, and again, if they succeed, they'll be making billions. But a lot of times they will be financing new and unproven businesses, and 9 out of 10 businesses will fail. So venture capital relies on investing in a lot of businesses at the same time. They know and expect most of those businesses will fail anyway, but the few businesses that make a profit will make an extraordinary profit and will make venture capitalists rich, very rich, okay? Because they all dream of becoming rich. All right, that's good enough. 10-minute break.